Hey there. Today we're going to tackle one of those economic terms you hear all the time, especially when people start getting nervous about the economy. It's a signal that some people swear by, calling it an almost magical predictor of the future.
I mean, seriously, what if there was just one single line on a chart that could basically call a recession before it even happens? That's what we're diving into today, the story behind this surprisingly powerful indicator.
And no, that's not an exaggeration. This isn't just some loose correlation. This thing has an almost perfect track record of sounding the alarm right before the economy takes a nosedive. So what is this mystery chart?
All right, this mysterious predictor, it's called the yield curve. But to really get why it's such a big deal, we first need to break down what it is and what it's supposed to look like when the economy is, healthy and humming along.
So put simply, it's just a line on a graph. It shows you the interest rate, or yield, you get for lending money to the U.S. government for different periods of time. You can think of it like a menu of interest rates, from a super short-term loan of just a few months to a really long-term one of 10, 20, or even 30 years.
Okay, so what does normal even look like for this curve? Well, under healthy economic conditions, it has a very specific, very logical shape. The real question is, why does it look that way?
It all boils down to two simple things: risk and time. Think about it this way. Would you be more comfortable lending a friend $20 for a week or for 10 years? Probably for a week, right? I mean, a lot can go wrong in 10 years, so you naturally want a little extra interest for that longer loan, just to make the risk worthwhile. Well, the bond market thinks the exact same way.
And that super simple logic is exactly why a normal yield curve slopes upward. More time equals more risk, which means you get a higher reward, a higher yield for investing your money. This shape is a good sign. It's a sign of confidence. It tells us investors expect the economy to keep on growing.
All right, so that's what's normal. But what happens when things get weird? This is where the story takes a really interesting turn. It's when the curve does something that feels completely backwards. It flips upside down. And this right here, this is the whole ballgame. An inverted yield curve. This means the market is suddenly paying you more for a short-term loan than a long-term one. Now just think about how bizarre that is. The market is basically saying it believes it's riskier to lend money for the next year than it is for the next 10. Why in the world would that happen?
This quote really hits the nail on the head. Investors flip the curve because they are scared, plain and simple. They have a collective feeling that an economic downturn is coming, and in response, they expect the central bank to start slashing interest rates in the future. So, they rush to lock in today's higher long-term rates before they're gone.
It's a classic case of supply and demand. All these nervous investors start piling into long-term bonds, which they see as a safe haven. This huge surge in demand drives the price of those bonds way, way up. And here's the crucial part. Bond prices and yields are like a seesaw. When the price goes up, the yield goes down. When that long-term yield gets pushed down so far that it's below the short-term yield, the curve has officially inverted. It's the market screaming that trouble is just around the corner.
So an inversion is basically a giant fear gauge for the market. But how reliable has that signal actually been? I mean, has it really predicted recessions? Well, the track record is pretty staggering. Just take a look at this timeline. An inversion has been the canary in the coal mine for every major U.S. recession for more than half a century. Before the downturns of the 80s, before the dot-com bubble burst, before the 2008 financial crisis, and yes, even before that short, sharp recession in 2020, the yield curve inverted first. The track record is just undeniable. Okay, so perfect predictor, case closed, right? Well, not so fast. This is where our mystery gets a huge new wrinkle. The modern economy has a massive new player in the game, and it might just be distorting this once perfect signal.
See, after the great financial crisis back in 2008, central banks all over the world, including the U.S. Federal Reserve, started using a powerful new tool to manage the economy. And that tool directly interferes with the bond market.
Look at this chart. It shows the U.S. Fed's balance sheet. It's pretty flat for decades, and then after 2008, it just explodes upward. All of a sudden, the Fed became a gigantic buyer of the very same long-term bonds that shaped the yield curve. This policy is called quantitative easing, or QE for short.
The key thing to understand about QE is that you suddenly have a huge buyer in the market who isn't motivated by profit or fear. They're motivated by policy. This creates a massive, and some argue artificial, demand for long-term bonds.
And what happens when there's huge demand for something? The price goes up.
and its yield goes down. This has kicked off a major debate among economists. Is a yield curve inversion today still a pure signal of market fear, or is it being artificially pushed down by these massive central bank actions? Is the curve still telling us about the future, or is it just reflecting policy decisions?
And that brings us right to the heart of the modern debate. On one side, you have people saying, look at the track record. It's nearly perfect. You can't ignore it. But on the other side, you have people arguing that the rules of the game have changed. They believe that with central banks now acting as such dominant forces, the yield curve's crystal ball might just be broken.
So where does that leave us? Is the yield curve still that powerful forecaster channeling the collective wisdom of the entire market? Or has it become an economic relic, its magic diluted by the very policies that were designed to save the economy? That's the billion-dollar question. And the next time you hear about the yield curve in the news, you'll know exactly what that debate is all about. Thanks for tuning in.